Welcome back to Real Estate Investing in New York with me, Christina Kremidas. And in this episode, we are talking about what will likely happen in the New York City residential real estate market if and when interest rates drop. So stay tuned. We're covering everything here. This is Real Estate Investing in New York with Christina Kremidas, helping you achieve a future of financial success by making intelligent real estate investment decisions today. Welcome back, guys. This is an episode that probably everyone is going to be very interested in tuning into because it's one of the most common questions that I get, which is around interest rates and what will happen when rates drop, if rates are going to drop, and what we're expecting and what we're seeing in the residential real estate market. So to start, I would like to say that the way I'm going to be able to inform you of this information is based on my knowledge of what has transpired in recent years and expectations about what might occur. But nobody has a crystal ball, and I don't like saying that I know that something is going to happen or that what I say will happen if interest rates drop before we actually get to that point where we are experiencing the economy at that time, because there are many different factors that affect the real estate market. It is not only interest rates, and there are several things at play, which I will give you information about. But at the end of the day, I don't have any, psychic insight that other people don't have. Some people speak very confidently with conviction, which is great, but I don't like to mislead people either. So just know that any expert on the matter is all using the same data and information and prior experience that we all have. And the way they articulate things might sound good or bad, but you should take everything with a grain of salt because not everyone is always right. So I just wanted to let you know that as we go into this episode, I'm doing the best I can for you guys to make these predictions, and I believe that I'm correct, but of course, you never know. Interest rates skyrocketed, it felt, after the pandemic, and they have trickled down recently. So finally, we are seeing interest rates come down. They are at the lowest they've been in the past just about year and a half. So that has been very good to see. During the pandemic, the rates they had been actually historically low. It didn't have anything to do with the pandemic. For probably a decade prior to the pandemic, the rates were at the lowest we had seen in many of our lifetimes. The rates were in the threes in terms of, some people had even twos and threes interest rates in terms of percentage that they were paying in interest on their mortgage loans. That was historically very, very unique, and that is not something that people had seen before. Interest rates were in the teens just a generation ago. So keeping in mind that rates feel high right now, historically they're not really all that high, and thankfully they are coming down. But people started to get used to the higher rate environment, but still not so much. The environment here in New York City has definitely been a buyer's market, especially lately. There's discounts across Manhattan to be had. Other areas are much more competitive, but I would say that in Manhattan, unless we're looking at a truly unique property, there's opportunities for discounts across the board. The market is not moving very quickly right now. It hasn't been moving very quickly for, I would say, the past 5 months at least. So it's been a quieter summer than what you would typically expect, even for the fact that summer is usually slow. And buyers are exploring and they're interested, but they haven't necessarily been seeing properties that work well for them. And that has been one of the biggest reasons for the slow movement in properties. So the reason for this market being kind of odd, the pandemic brought about a very interesting market dynamic that we hadn't really seen before. And this was related to the idea that New York City living was going to be obsolete. And that was because of the idea of, people in a close proximity was very uncomfortable, and the new ideas and premises and policies that were brought about with the pandemic were very new for New Yorkers. And it caused people to, of course, want to leave the city for space and open air. And that rendered apartment prices in the city very, very temporarily low. So there was a short period of time where there was negotiability in the Manhattan real estate market during the time of the pandemic, but not as much as you would expect for the fact that there was a global crisis happening. And the reason for that was because there was a crisis at play, but it wasn't an economic crisis yet for consumers. Consumers were employed, they were working from home, they were spending less money out on events and dining and the things they usually spend money on, and people actually had money. People actually felt like they were okay. Many people, not all, of course. If you worked in hospitality or service, you were heavily affected. But during the pandemic, there were a lot of people that were able to buy their homes without a problem and were actually picked up investment properties. And there were a lot of deals taking place throughout the entire pandemic. I really wouldn't say that there was any moment that was extremely slow, honestly, even though we weren't legally even allowed to show apartments. We were doing transactions based off of completely virtual showings. So there was very much demand the entire time. And then shortly after the initial onset of the panic of the pandemic, people really hit the real estate market strong in New York City. They realized that there were some discounts to be had. They assumed that the discounts were even greater than they were. And if they were in any position to do so, they were going to go out and bid on apartments, figuring that that was a golden opportunity. And in hindsight, it really was, because there was some negotiability to be had and the rates were very, very low. So these people locked in great apartments. Now the environment has changed. So after the pandemic, there was a crazy rush on apartments and the real estate market shot through the roof. And there were pretty much bidding wars on everything. It didn't even matter if the apartment was nice. There was going to be a bidding war on it, because again, we had a lot of people who felt financially strong, and there was a very clear indicator that the New York City real estate market was not dead, was not going to die. And it pretty much proved that despite an apocalyptic event, the New York City real estate market would still thrive. And that was proof of concept for many people, and it spurred a huge demand on properties here in New York City. So prices skyrocketed, and interest rates at that time were also still very low. Fast forward a couple of years, and we have a totally different scenario on our hands. The interest rates have gone up significantly to offset inflation, and we had buyers really pull back. For a long time, they were used to low interest rates, and now we were seeing increased interest rates for the first time in a while. So it freaked a lot of people out, and everyone thought that it was very temporary, just to fix the inflation problems that came out of the pandemic. And everyone thought that they would wait a little bit and get right back into the market. But that's lasted now for a while. So it's been probably a little over a year that the market has been pretty slow. And this year we expected the market to get better, which it did temporarily, and then it slowed down again. And I'll tell you why. And this is what it has to do with the rates. In the beginning of this year, we did expect that rates would drop. We were being told that by the middle of the year, the rates would be coming down. So buyers, with all of this pent-up demand, hit the market like wildfire. It's difficult to really put into words what March and April of this year felt like in terms of how busy the market was. But to put it into context, my team alone did about 80% of our total transaction volume from 2023 in those few months of 2024. And that's big. So the amount of transactions going on and the amount of buyers that were out during that period was immense. And we could barely keep up with the demand for our buyers wanting to see places. And things felt very rushed and urgent because everyone wanted to secure a place and negotiate a price and solidify the apartment and get into contract before the rush got worse, when the rates actually dropped significantly. because they knew there would be even more competition. It would be even harder once that happened. So it's kind of like trying to time the bottom. And the reason why they wanted to get into contract even before the rates dropped to the lowest that they thought they would get to was because they wanted to beat other buyers to that apartment, or they wanted to beat other buyers while the prices were low. But also because it takes several months to close a transaction in Manhattan, because you're dealing with condo and co-op buildings that take a very long time for approvals. If you're getting a mortgage, you have a long period of time where the bank is doing due diligence on these complex buildings. So mortgage commitment letters take a while to come through. So even after signing a contract, you could still be a couple of months away or a few months away from a closing date. So people were looking to sign for something, secure a price, a desirable price, and secure the residence that they wanted, and then renegotiate with their lender prior to closing, which many lenders are willing to do. You should ask about it if you're not aware. But the lenders can renegotiate your interest rate if it drops before you close, and ultimately you can close with a better rate. So that's what people were hoping for. So we had many people get into contract, and the rates kind of stay where they were, and they still ended up closing, and they still ended up doing transactions. Some fell out of the market, but many of them at that point had just put so much into it at that point, and they were securing great prices and decided to still go along with the purchase, even though the rates had not really come down to where they were hoping for them to be. So there was a rush in March and April, and that was an indicator of the type of pent-up demand that exists. But not nearly all of the buyer demand was addressed during those initial 2 months. There were many buyers that didn't find something because, again, low inventory environment, and many buyers that are still to this day waiting to get into the market. And economically, the buyers, that what I've been seeing is that many of the buyers that were in a position to buy earlier this year are still in a position to buy. Knock on wood that still remains the case later in the year or early next year. But right now, they are still in a position to make that purchase. So I would say that pent-up demand is still there. There are several economic factors that might contribute to an overall recession, which would affect the market in a negative way. And a couple of those factors are pandemic relief funding, which has been essentially keeping many commercial buildings and businesses afloat since the pandemic, are only now starting to expire. So this is a new development in economics today, is that there have been people collecting checks since 2020, and those are coming up on expiration. Some of them are being renewed, but really there still is an artificial boost right now for many businesses and definitely commercial buildings that are keeping these owners afloat, that are a ticking time bomb. So when these relief programs expire, there's a very big chance that there will be many foreclosures on different property types, which would bring pricing down. So while everyone thinks that the residential market is going to skyrocket when interest rates go back down, I do believe that to a certain extent, and I do believe that there's going to be an immense amount of demand, and there's going to be potentially bidding wars. I don't know that we're going to see a crazy spike in property prices like what people are fear-mongering buyers into believing. I think that prices are going to get firm. Prices are going to get competitive, but I don't know that the rates are going to drop to a point where people's budgets become obscene or, way higher than they currently are. I don't know that if affordability is going to miraculously improve that much for people to bid to an irrational place, like over asking prices. I don't know that would really happen very, very quickly. I do think that there's going to be many transactions that happen, and I do think that there's going to be a lot of demand if the rates drop. If rates do drop, they're expecting, this is just the talk, right? Because no one really knows everything. Again, they've dropped already, but if they do continue to drop, and if they drop more significantly, it would probably be towards the end of the year or early 2025. And that's when I would assume we're going to be seeing a big uptick in terms of buyer activity and prices firming up in the city. Currently, right now, I've seen a small uptick in my buyers. The listings that I have gotten more inquiries in the past couple of weeks. My current buyer clients have gotten more active, but I would not nearly say that the market feels like it's a seller's market yet. And I would not nearly say that I feel that there is a crazy rush of buyers yet. I do believe that that's going to happen because we saw it in the early part of the year. We saw that happen in March and April, and those people are still economically in a similar position, which makes me believe that they are still going to want to get back out there and kind of finish what they started once the rates look like they're going to drop again. So what we're seeing is my buyers are starting to creep back out, and the savvy ones, they're trying to start looking this month to hopefully secure something within a month or so that ideally by the end of the year, when we're ready to close, they can again negotiate with their lender, get a little bit of a better rate, and close and kind of beat what might be a mad rush to the market, which would drive prices up, and it would also create competition. And more than driving prices up to an irrational place, the competition means buyers will see other buyers in open houses for the first time in a while, honestly, in Manhattan. Like, open houses are not crazy right now. We'll have several attendees, but it's not like you're seeing a line down the hallway like we used to see. So that will happen. There will be more demand. And when buyers see that competition, they tend to bid more quickly. They don't get hung up on minor things as much as they tend to get hung up on more minor things when they know no one is bidding against them. So properties will trade more quickly, and properties will trade closer to the asking price or maybe a bit over. And that's what I anticipate will occur when the rates start to drop. There are some less obvious things that I would like to also mention during this episode that I think you're going to find very relevant, and that also is how this will affect the rental market. The rental market has been horrible, meaning extremely high demand and extremely low inventory for a long time, like the worst place we've been in a while. The issue mainly with the rentals is that a lot of would-be first-time home buyers had their affordability sucked out of them with all of the inflation and all of the increased mortgage rate issues. So they have renewed their rentals. They've stayed in their rentals much longer than they planned to. And they did not free up that inventory for the incoming renters that would want to take it. They're still in their rentals. So that's one reason. And the other reason is that coming off of the pandemic, and I mentioned this in a recent episode as well, but coming off of the pandemic, we had a lot of people that took rental apartments that were vacant who were coming from out of town. The people that took these vacant apartments during the pandemic for very low prices came from out of town. They were like your Connecticut renters, your Chicago, your Boston, people that were well employed that wanted a pied-a-terre in the city, that always dreamed of this but could never justify it. The pandemic pricing for rentals allowed them to experience that. And instead of freeing up the inventory and giving the rental apartment back when the pricing went back up to normal and above normal, they actually renewed at much higher prices. This was because they loved the experience of having the apartment. They really enjoyed it. And they were always in an okay place financially. They were well employed and had this extra money from the beginning. And they've been able to, not happy about it, but they've been willing to re-sign their leases at much higher prices than they first got it. Like, they got the taste of the Manhattan rental pied-a-terre and they wanted to keep going. So ton of inventory has not been freed up for renters. And that's a couple of the reasons why the market is so bad for rentals. So if people can get back into the buying market, of course the interest rates are really affecting her first-time home buyers, people where a couple of points on your interest rate are really going to significantly affect your affordability and cause you to hold off on your home buying. This market will thaw, this will come back out. They'll go from their rentals into their first apartments that they own, and they will free up that rental inventory. So I do believe that rentals might see a little bit of relief too if the interest rates go down and people can start buying again. Another thing that will likely happen is that if we can get a relief from inflation, there are a number of things that will be incentivized. Builders will be able to build again, and it will be more reasonable and affordable for them to do so. And there will be more development projects that occur, which will create more housing units across the board. Housing units being created means that there is more supply, and more supply means more options. And that always inherently means that the pricing would not need to skyrocket because there's more choice choice for buyers potentially. So we have seen that across the city. There have been permits filed across the city for about 1.5 million housing units that developers have the intention of building, which would help alleviate the strain on supply and the lack of supply. So if this can happen, it would also cause things to feel more balanced. So even though there will be a rush of buyers, hopefully and ideally over the coming years, it will be offset by an increase of inventory, and developers will be alleviated as well because they'll be able to build and they'll be able to source their materials more affordably than it's been for them the past year or so with this rampant inflation. And they'll be more inclined to put in new development projects and be able to complete their projects on time, which would be great to be able to get back to a world where projects can be completed on time that are construction and things can start trying to like resume the way they should, you know, a little bit closer to what would feel balanced. So what you can expect if you are a seller, you should start discussing, if you're interested in potentially selling, you should discuss what your pros and cons are of getting your listing to the market. You should call your real estate agent and start talking with them about what to expect, timing, what's an ideal time frame, what your goals are, what the price is that you'd like to net out with, and exactly what those details look like for you to get into the market with your listing. There is going to be a need for your listing to hit the market, and in order for this market to be balanced out, we need listings to hit the market. In order to get this continued rush of buyers to the market, there has to be things for us to show them. So your listing hitting the market will help buyers see that there is stuff out there to look at, and it will help get things going in the right direction. And I suggest that you start discussing it. You may not want to list this month, but maybe you want to list next month, or maybe you want to list in Q1 of next year. Okay, so this is something that you should be actively thinking about and strategically discussing with your real estate agent today. If you are a buyer right now, I would, of course, recommend that you start gearing up your search. We've seen listings start hitting the market, thank goodness, this fall. Fall always proves to be great for inventory in most markets across the city. When it comes to seasonality, listings hit the market in the fall, and we are starting to see listings hit. Finally, we did not see the spring inventory that we usually expect hit the market this spring, which was another one of the reasons why the market fizzled out. There was nothing that hit in the spring, really. The fall, we're finally seeing things come. So if that continues, we'll have good stuff to look at. You know, the buyers will have good stuff to look at, and sellers will get their traffic because buyers will be out looking. So I highly recommend that you start doing that research now. Again, link up with your buyer's agent and discuss the intricacies of working with the buyer's agent. Decide whether it's something that you're interested in, and get out there and start arranging appointments, start looking at homes, because I do believe that you're going to want to be one step ahead of the rest of the buyer competition that is bound to hit the market within the next couple of months. If you are a buyer, you can expect fewer days on the market. I mean, I suppose that this is also very relevant to sellers. Fewer days on the market for listings. We've seen a greater than usual average number of days on the market for properties in the past few months. They've been kind of sitting. Listings have been going stale. There hasn't been a buyer to scoop them up just yet. It's not because they're bad properties, but it's because when there is no direct competition, it just takes people a really long time to pull the trigger when they know that there's nothing like competing, there's no one competing with them, there's no real sense of urgency. The rates were not expected to drop in the near future, so there was no urgency. So it was pretty much, you know, every buyer felt like, okay, I'm just gonna wait until I see something perfect. And of course, like, perfect doesn't usually really happen, but we can get close to perfect. And I think that now is the time that we are going to be able to see that inventory. There's going to be more to choose from, and you're going to want to get out there ahead of your peers, ahead of other potential home buyers. You can expect for listings that you like to start getting scooped up much more quickly. You can start to see that probably go to just a couple of months or less than a couple of months on the market is what I would expect for like average properties, which is pretty average in New York City. And for desirable properties, I would say that they'll be getting scooped up in under a month. Similarly, and pretty obviously, you can expect some bidding wars. You'll definitely see multiple offers on properties. Whether or not the price will be driven up again to the place that you imagine when you hear the word bidding war is TBD. We don't know. I don't think that many experts are anticipating a ridiculous spike in prices, but we're going to see properties move. We're going to see them trade quickly, probably at asking, maybe a little bit above. And keep in mind too, the asking prices now that you're going to be probably comparing mentally for properties on the market versus what they will be, asking prices have dropped. So there have been major price drops across the city. So typically you see properties that are a bit overpriced and they're leaving room for negotiation leverage. In busy markets, that's the way to do it. So as you compare, you'll feel like, similar properties are a certain price point. Those price points have been lowered. So now everybody's baseline expectation is lower because we were in such a slow market in the city that in order to get your deal made and in order to move that property, we had to price at true market value or below. And most of our properties have been trading for below. So in order to get that buyer in the door, we had to do price drops. And finally, when the property price is low enough, you get that person in the door. You get those buyer eyeballs on that listing and you get those people in the door. And then from there, for example, a couple of listings that I managed recently, market got slow. We did price drops to below market and then we got a bidding more back to true market value. So that's what you're seeing. So you may say, oh, this apartment was listed for $850,000. The new property in a busier market might be listed for $900,000 or $950,000. And you'll say, this is so overpriced. It's not really that it's overpriced. Of course, by then you'll have closed sale data to look at. So you'll notice that properties might have gone for above asking price and you'll be able to adjust your expectations. But keep in mind that the market determines the value and there are certain markets where properties come on the market underpriced and other markets when properties come on the market a bit overpriced. So the best way to negotiate the correct price for the unit is to have an agent that is going to run proper comps and numbers for you, give you the right advice, and ultimately make sure that you're securing a deal, but it's going to be in line with market and you want to make sure that you're looking at the right information. You want to go into the next season that is surely going to be more competitive without expectations around pricing that you've seen in bad markets. And that is so important because the market changes very quickly. Markets swing very fast. There's not much warning. Timing the bottom of a market is nearly impossible. And when the market swings, if you don't adjust your mindset quickly for what's currently going on, you will lose out on bid after bid and you will miss out on apartments that you wish you secured. So I would say trust your agent and, keep a level head about you, but just understand the trends that we're about to see and understand that it will feel like a night and day light switch that will go on. All of a sudden, we're going to be very busy. And, if you go into it saying, oh, it's slow, no, it's not. That's going to be old news very fast. So have that understanding and have that expectation and simply act accordingly. You're not going to overpay, but you need to be aggressive and you need to secure that place and you need to come prepared. You need to have your pre-approval letter ready. You need to have your team lined up. You need your loan officer, your real estate attorney, and your real estate agent all working in sync. You need all of these people present and ready to help a seller understand that you are the best offer that they have and that you are worth engaging with. And that's how you'll maintain any bit of negotiation leverage that there is to have. So these are very important things. I recommend that you reach out to your resources and you secure your resources and you assemble that team and you start getting ready. And that kind of sums it up. I mean, I guess you could say that some of this information was obvious. I hope that I added a little bit of additional color for you. At the end of the day, no one knows exactly what is to happen, but we do expect that rates will continue to drop. And we do hope that by the middle of next year, we are in an environment where properties are moving and that we are in an environment where the rates are lower than they are today. And those are my predictions. I hope that you found them helpful. And of course, there might be a specific question that you may have related to this that I didn't directly address in this episode. I'd be happy to inform you and I'd be happy to help you understand any of the questions that you have. Sometimes direct questions are actually easier for me to answer than trying to think about what everyone's question is and just formulate an episode like from from my own thoughts. So I greatly welcome your thoughts and your questions and your feedback. Please send me an email. My email address is christina.kremidas@element.com. You can go to my website, christinakremidas.com, and access all of my contact information. You can learn more about me. You can learn more about my team, and you can reach out to me from any of those methods. Don't forget to follow along on Instagram and TikTok. My handle on both of those platforms is christina.kremidas. And finally, if you're listening on the podcast, thank you so much for being here. Thank you for being a part of this. Feel free to share it with a friend and help more people get a hold of great real estate investing information in New York City. And if you are watching on YouTube, thank you so much. Please like this video and please subscribe to the channel so that you can be notified when new content is uploaded for you. So thank you guys so much again, and I will see you soon.